what happens essentially in zero DTE options, and it kind of shows you the ranges. So we're calling this intraday theta behavior in zero DTEs. But the key takeaway here that I want you guys to see, that I think is really important, is how much difference, or how much, not that there's higher probability of success when volatility is high, it's just how much more money you can make when volatility is high as opposed to being low. And right now, volatility is low. So right now, the risk reward, not that great. The risk reward when volatility is significantly higher is just so much better. That's the real takeaway from this piece. But let's give it a quick look. So Theta measures in dollars per day how quickly an option is expected to lose extrinsic value should the spot price and the volatility remain steady. I mean, that's the only assumption we can make, is that everything remains steady. But we're going to show you kind of the ranges. So Theta serves as both an indicator of short-term option profitability and a measure of the risk via its inverse relationship with gamma. So if it doesn't move, gamma's low. If it moves, gamma's high, and so on. So we're going to explore the Theta values available at the money zero DTE options that have fluctuated throughout the trading day. Last night we did a zero DTE ES option and it worked out nicely, but we went to the expected move. Our preference is usually to go to the expected move. Why is that? Because it's just less pressure. Right? That's it.
Well, I mean, we let the numbers do the work for us, and then say, "Come and beat us." I mean, that's a lot of our trading style, right?
Yeah,
you didn't have very high implied volatility either, so there was no hero crap there. And if you didn't close that this morning with this rally higher, it would be a losing trade. So it goes to staying mechanical too. A lot of times people try to squeeze all the juice out of the lemon, and at some point now you'll have a losing trade, maybe even twice as much as what you would have made.
Well, my main point was we're showing you an at-the-money option in this study today, and we don't usually do at-the-money options. We usually do the expected move. Does it make a difference? No. It's the numbers are a little bit greater if you do the at-the-money option. You can make more money. You can also lose more, but you have a little less adjustments to make, and you take a little less risk if you do at the expected move. But the visual would be the exact same. So we used 2 years worth of data. We did a snapshot, essentially. We took a snapshot every 10 minutes, and we aggregated across all days to find kind of the average from the zero DTs. From we start at 10:30 in the morning, and we keep going all the way to the close. Then what we did is we filtered by VIX, 0 to 15, 15 to 25, where we are right now, and then 25 plus. Central time for everything. Let's go to the first slide, Beth. The first visual. Okay, so what this is this is all days. So this takes into account high volatility, moderate volatility, and low volatility. This takes into account every single vol cycle, okay? Because you see, Tony says all days. And if you look on the left-hand side where you see the theta, it's somewhere between, let's just call it 1100. I'm just ballparking it, okay? But the colored area in the middle is the standard deviation. That's kind of the range. And the line in the middle is the mean. And you can see that on all days, if you're at the money, it's about $1,100, and it goes down to the end of the day to, whatever, close to zero, what it's supposed to, or just above zero. That gives you a picture of what it looks like on all days. But now we're going to go through each one of the cycles. So the first one is going to be when volatility is really low. Go to the next slide, Beth. So this is volatility below 15. Now, this is why it's so hard when volatility is cheap. Do you see where our starting point is here? Remember, 1,100 on all days, but here you're talking about starting point at closer to 800.
Right.
Okay, so over 30% less. Now, remember, you're taking kind of the same amount of risk, but you have this essentially the same design, but your starting point is 800. So your probability of profit is going to be virtually the same, but you just don't make nearly as much money. Now let's go to the next slide, where you have, this is where we live right now, which is between 15 and 25. And you can see here that the number is much higher. Our starting point's about 1,200, which is over the mean, which is good. And that's where we are right now. This is what we call kind of the average or moderate range. Now, you can see how on the charts, everything's going to look the same, but this is kind of like what we would consider to be not necessarily a sweet spot, but this is where we would consider this to be kind of just more of an average. This is what you get most of the time. It's good too. It's better than all days, and it's much better than low volatility. It's not as good as high volatility. That's where we live right now.
Yep. That's where we are. Yeah, we're actually going lower, right?
But if you see the next slide, perfect, which is the intraday evolution over 25. And in this case, your starting point is almost $3,000. It's almost, 3 times what it is on all days. Mm-hmm. Now, how come this doesn't skew the averages so much higher? And the answer is because we don't have a lot of days where the VIX is over 25. It's a very rare occurrence where the VIX is over 25. So because of that, it just doesn't, we don't have enough days up here where you can sit around and wait. But you can see the difference. All days are 1,100. The low VIX is 800. But when you get a high VIX, it's almost 3,000. So where we are today, between where we are today and the high VIX, is kind of much more of we'll call it the aggressive case, but also a little bit of let's call it where we really want our sweet spot to be. All the graphs look the same. Yeah, is the standard deviation here wider? Of course. Is there more ridges and more outlier moves? Of course there is. And there's, of course, at the end, this is going to be, even though you're going to have the same probability of profit, you're going to have a little bit less, you're going to have a lot more volatility. But the takeaway from this is just the amount of potential is so great compared to the really low implied volatility. This is just designed to be a visual of that.
And it's a good visual. I get it.
Yeah, it's a really good visual.
Yep.
Let's go to the takeaways, Beth. Okay, so although theta decay generally accelerates through the lifespan of a long-dated option, or just a zero DTE option, its behavior on expiration day can be unexpected. The typical at-the-money zero DTE option declined roughly linearly over the course of a typical trading day, with minimal gains or losses remaining by the afternoon. So on high volatility days, the trend persisted, but with a much wider range of outcomes around the average. Even when waiting until zero DTEs to trade highly responsive options, it's important to execute trades while there's still enough premium in the market to make the trade worthwhile. Like we had a zero DTE trade on this morning. The expected move was $28. Yes. We took the trade off when it came in overnight over $5. But now that same trade, if we had waited an hour longer,
it's probably a $5 loser.
Probably close to a $5 loser.
Right.
Okay, because we've gone almost 1.5 times outside the expected range.
That's correct.
So a lot of this is timing. Like when we're doing a study like this, you don't get the choice of covering early. But when you're trading, you get to cover early. This is true. I mean, it's so important that you take profits when you're trading the 0 days. Because my trade today is a perfect example. It was a really nice winner this morning. It would have been it was a $5 winner this morning. It's probably a $5 loser right now.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.